Every time conflict erupts somewhere on the globe, the ripple effects travel far beyond the battlefield. They move through pipelines, across shipping lanes, and eventually land directly in your wallet every time you pull up to a gas pump. The connection between geopolitical tension and fuel prices is not a coincidence. It is a deeply embedded economic reality that has shaped energy markets for decades, and right now, that reality is hitting harder than ever. When countries go to war or even threaten military action, the uncertainty alone is enough to send oil markets into a frenzy. Traders, investors, and energy companies begin making decisions based not on what is happening, but on what might happen. That fear premium gets baked into every barrel of crude oil traded on global markets, and consumers end up paying the price at the pump before a single shot is even fired. The Middle East has long been the world's most critical oil-producing region, and any instability there sends shockwaves through global energy markets. Countries like Saudi Arabia, Iraq, Iran, and the United Arab Emirates collectively control a massive share of the world's oil reserves. When tensions rise in that region, whether through direct conflict, sanctions, or political instability, the flow of oil becomes unpredictable. Similarly, the conflict between Russia and Ukraine fundamentally changed the energy landscape for Europe and beyond. Russia was one of the world's largest exporters of natural gas and crude oil. When Western nations imposed sweeping sanctions in response to the invasion, global supply chains were forced to reorganize almost overnight. Europe scrambled for alternative energy sources, driving up demand and prices worldwide. The United States, while more energy independent than many nations, is still deeply connected to global oil markets. Domestic prices are influenced by international supply and demand, meaning that a conflict thousands of miles away can still raise the cost of your morning commute by 30 or 40 cents per gallon within weeks. Understanding this connection is the first step toward making smarter financial decisions during periods of economic turbulence. They trigger a chain reaction across the entire economy. Transportation costs rise for businesses that ship goods, and those costs get passed directly to consumers through higher prices on groceries, clothing, electronics, and virtually everything else. Airlines raise ticket prices. Delivery services add fuel surcharges. Heating and cooling bills climb as energy costs spread across all utility sectors. Inflation, already a persistent challenge in recent years, gets a powerful boost from rising fuel costs. The Federal Reserve responds by adjusting interest rates, which then affects mortgage rates, car loans, and credit card debt. What begins as a geopolitical conflict in a distant country eventually touches the financial lives of ordinary Americans in ways that feel deeply personal and unavoidable. Treasury inflation-protected securities, commonly known as TIPS, are government-backed bonds specifically designed to keep pace with inflation. Series 1 savings bonds are another option worth exploring, offering inflation-adjusted returns with the full backing of the United States government. Financial experts consistently recommend having 3 to 6 months of living expenses saved in a high-yield savings account. During periods of economic uncertainty, that cushion can mean the difference between weathering a storm and falling into serious debt. With interest rates elevated, high-yield savings accounts are currently offering returns that were unimaginable just a few years ago, some reaching 5% annually, making this one of the most practical and low-risk moves available right now. The second strategy is to reduce your exposure to variable-rate debt. Credit cards and adjustable-rate loans become significantly more expensive when interest rates rise, which is exactly what happens when inflation driven by energy costs forces the Federal Reserve to act. Paying down high-interest debt aggressively right now protects you from compounding financial pressure down the road. Even redirecting a small portion of discretionary spending toward debt reduction can have a meaningful long-term impact on your financial stability. The hidden cost of war is real, and it is already embedded in the prices you pay every single day. But awareness without action is just frustration. The global forces driving up gas prices are largely beyond any individual's control, but your financial response to those forces is entirely within your power. By building savings, reducing debt, investing strategically, cutting fuel costs, and protecting against inflation, you create a personal financial buffer that insulates you from the worst effects of geopolitical instability. The world will always have conflict, and energy markets will always react. What changes is how prepared you are to handle the consequences when they arrive at your doorstep. The global economy is on a roller coaster right now, and it's okay to feel a bit uneasy. But by understanding the why behind the price hikes and adjusting your daily habits, you can stay ahead of the curve. Question for you. Have you noticed gas prices going up in your area yet? Drop the price and your city in the comments below. Let's track this together. And if you want more simple hacks to manage your money during these crazy times, hit that subscribe button. Stay safe, stay informed, and I'll see you in the next one.